All right, today we are digging into a framework that tries to solve one of the oldest, most frustrating problems in investing, that constant battle between going for growth and just playing it safe. It's called the ACDP framework. That stands for Automated, Concentrated, Diversified Portfolio. And trust me, it's a really fascinating way to look at things. You know, every single investor, it doesn't matter if you're a pro or just getting started, you face this exact dilemma. It's this nonstop tug of war, right? You're chasing those big returns, but at the same time, you're terrified of losing your shirt. It's growth versus safety, and it feels like you can't have both. So just think about your own portfolio for a second. Is it designed to shoot for the stars? Or is it built like a bunker, ready to handle any storm? Well, this paper asks a really simple but profound question. Why does it have to be one or the other? Why can't we have both? Okay, so traditionally, you've got two main camps. In one corner, there's concentration. This is where you put all your eggs in just a few baskets you believe in like crazy. The upside? It can be absolutely massive. The downside? You could also suffer a catastrophic loss. Then, in the other corner, you've got diversification. You spread your money out so thin that no single failure can hurt you too bad, but your returns get so diluted you might as well just be tracking the market. The point is, neither one is a perfect solution. And this is where the ACDP framework really starts to shake things up. It asks us to completely rethink what diversification even means. See, it's not about how many things you own. It's about owning the right combination of things that can survive totally different versions of the future. And this slide really highlights that mental shift. The old, traditional question was all about quantity. How many different stocks do I need? But the new ACDP question is about purpose. How many different economic worlds is my portfolio ready for? It's a huge shift from just counting your assets to actually preparing for different outcomes. And boom, there it is. This is the big aha moment of the whole thing. This one sentence is the key. Be concentrated in your big ideas, the things you truly believe in, but be diversified across the different economic environments, or regimes, where those ideas have to survive. It's a genius way to get the best of both worlds. So, that's the big idea. But how do we actually do it? Let's get into the nuts and bolts of the ACDP framework itself. This is the system that's designed to let you invest with real conviction, even when you have absolutely no idea what's coming next. The whole framework really rests on three simple but incredibly powerful pillars. First, it's built to fight our own worst enemy, our own brain and its biases. Second, it makes you focus only on the big picture, macro-level ideas. And third, and this is so important, it automates everything to get our emotional, panic-prone selves out of the driver's seat. So let's look at how it actually fights those mental traps we all fall into. It tackles home bias, our tendency to only invest in our own country, by forcing a global view. It counters recency bias, that feeling that whatever just happened will keep happening, by treating a downturn as just a piece of data, not a death sentence for an asset. And finally, it uses cold, hard automation to stop us from giving in to loss aversion and panic selling at the absolute worst time. Okay, so this is where the rubber meets the road. What does a portfolio built on this philosophy actually look like in practice? We're about to see how ACDP puts its money where its mouth is. Not by buying a little bit of everything, but by making a few big bets on different economic drivers. The model basically boils down the entire global economy into a few core distinct bets. You've got U.S. equities, which is a bet on a future of continued American innovation and dominance. You've got Chinese equities, which is a bet on a future where government policy sparks a massive rebound from today's pessimism. You've got gold, which is your bet on a future filled with uncertainty and instability. And then a domestic index like the NIFTY here for local growth. Each one of these is a bet on a completely different possible future. So let's break that down. Why the U.S.? Well, the thinking is that it has a unique structural role as the world's innovation engine. It's like a magnet for global capital, and its companies tend to grow because of real gains in productivity. It's a very specific bet on a future driven by high-tech growth. And then you have China, which is fascinating because it's in the portfolio for almost the opposite reason. This is a contrarian bet. The idea is that valuations there are so beaten down by negativity that any kind of positive policy surprise from the government could cause a massive snapback. It's what you'd call an asymmetric bet on things just getting back to normal. And what about gold? Well, gold has a very simple job here. It's the chaos hedge. It's your portfolio's insurance policy. It's not supposed to do well when everything is sunny and calm. It's there to protect you in a future where confidence in paper money collapses, or where geopolitical tensions go through the roof. It's designed to zig when everything else zags. Now, this next point is absolutely crucial. You do not need all of these bets to pay off at the same time. In fact, the portfolio is designed assuming they won't. The whole strategy can be a huge success if just one of these futures, say the US innovation story, goes on an incredible run, while the other pieces just manage to not lose a ton of money. That's the real beauty of this structure. So all of this brings us to the core philosophy that holds the whole framework together. The paper calls it structured conviction, and it's really a mindset that's all about one thing: surviving first so you can be around to win later. And this quote just says it all, doesn't it? Avoiding those huge, painful drops in your portfolio's value, what we call drawdowns, is way more important than squeezing out every last bit of profit in the short term. The biggest factor in building long-term wealth isn't hitting home runs, it's avoiding those catastrophic strikeouts that take you years to recover from. Defense wins championships. So, let's just wrap this all up. We started with that classic investor's problem. Standard diversification can feel kind of boring and ineffective, while putting all your eggs in one basket is just terrifyingly risky. The solution that ACDP offers is this really elegant middle ground, a disciplined, systematic way to invest with real conviction, even when the future is a total mystery. And that really leaves us with one last big question to ask ourselves about our own strategies. Is your portfolio built on a single, fragile prediction about what's going to happen next? Or is it truly built to be robust, designed not just to survive, but to thrive across many different possible futures?